Have you ever dreamt of making money while you're lost in dreams? No, this isn't an illusion but the magic of passive income. Captivating idea centers around fabricating a revenue stream that ceaselessly fills your bank account, independent of your active employment status. Imagine it as tree that you initially nurture, a tree that consistently bears fruit. The tree symbolizes your initial investment, whereas the fruits denote your financial gains. Passive income is a potent strategy that can revolutionize your financial landscape. This income can spring from a variety. Some investors are inclined towards dividend, companies that share a part of their profits with shareholders. Alternatively, some choose bonds, which are essentially loans to a corporation or government, repaid with periodic interest payments. Next, we bring to your attention real estate investment trusts, or REITs. These are investment channels that assign you a stake in real estate without the need to directly own properties. Also, high-yield savings accounts can serve as a source of passive income, as these boost your savings at a rate faster than traditional savings accounts. Now, the thought that might be brewing in your mind: how do I kickstart investing for passive income? Stay connected as we explore this fascinating realm. In investing, risk and return are two sides of the same coin. They're inseparable in your financial journey. Risk refers to the loss potential of your original investment. It's the what-if causing unease in investors. Return, however, is the gain or loss made on an investment. It's reward for taking on risk. Risk and return form a unique dynamic known as the risk-return trade-off. This suggests that higher returns come with increased risk. It's like a seesaw. As potential for higher returns rises, so does risk, and vice versa. This balance must be carefully navigated by every investor. Some might welcome higher risk for greater returns, while others might opt a safer path with lower but more consistent returns. Understanding this key relationship is crucial for making informed investment decisions. It lets you weigh potential rewards against risks, aiding you in making decisions that match your financial goals and risk tolerance. Remember, in the world of investing, knowledge is power. So equip yourself with this understanding as we move forward into the basics of investing for passive income. Before you start investing, it's crucial to understand the basics. Investing means buying assets expecting they'll appreciate over time, putting your money to work. This involves three key concepts: diversification, risk management, and long-term planning. Means spreading your investments, mitigating potential losses. Risk management involves controlling the level of risk you're comfortable with, influenced by your financial goals, age, and tolerance for uncertainty. Long-term planning realizes that investing isn't a get-rich-quick scheme. It's a long-haul strategy. And then there's compounding. Your earnings generate more earnings, like a snowball effect. Your investment yields returns, these returns are reinvested, and your wealth grows. This snowball effect makes investing a potent tool for building passive income. You're not just profiting from your original investment but also the returns it generated. The longer your investments compound, the more your wealth snowball expands. With these basics in mind, you're ready to dive deeper into the world of investing for passive income. Investing for passive income is like setting off on a journey. Financial planning is a practical map for this journey. Essentially, it is the practice of setting financial goals and creating a strategy to accomplish them. It is much more than just investing. It encompasses managing your finances to help you reach your objectives, such as buying a house, retiring comfortably, or amassing wealth. It is instrumental in risk management, savings, and investment. It aids in understanding how much risk you can take, how much you should save, and where to put for optimal returns. To create a sound financial plan, first, pinpoint your financial objectives. Assess your current financial status, including your income, expenses, savings, and debts. With a clear picture, you can initiate your plan, which might involve setting a budget, paying off debt, creating an emergency fund, and investing for the future. Remember, your plan should be adaptable to life's unpredictable changes. With a robust financial plan, can navigate your way to financial freedom. It's your roadmap to achieving your financial goals and making your journey to passive income a successful one. There's a wide variety of investments that can generate passive income. Let's explore some of the most popular ones. Dividend stocks are shares in companies that give a fraction of their profits to shareholders. They can offer an income flow even in a down market. But there is market risk. Then, we've got bonds. Simply put, when you buy a bond, you're lending money to an entity and receiving interest over a certain period. They're safer than stocks, but the returns can be less. Third are real estate investment trusts. or REITs. These are companies that own and manage income-generating real estate. You can earn from real estate without the need to buy or manage it. However, the real estate market can fluctuate, and REITs can be complex. Lastly, we have high-yield savings accounts. They offer higher interest rates than regular savings accounts, making them one of the safest ways to earn passive income, but the returns are usually modest. Each of these investments has its pros and cons. It's up to you to decide which ones align with your financial goals and risk tolerance. Having explored the types of investments for passive income, let's dive into some strategies you can adopt to generate this income. The first method is dividend investing. It is about purchasing stocks of companies that pay regular dividends. However, keep in mind that dividends are not guaranteed, so proper research is crucial. The second approach is real estate investment. It involves buying rental properties, with success heavily dependent on location and tenant reliability. It requires considerable initial investment. The third way is peer-to-peer lending, lending money to individuals or small businesses online. This can yield high returns, but there's risk of borrower default. Each of these strategies has its own potential rewards and risks. Choosing the right one depends on your financial goals, risk tolerance, and investment horizon. Remember, investing is not a one-size-fits-all endeavor. What works for one person may not work for another. It's all about finding the strategy that fits your unique situation and goals. So, you're ready to start investing. But where do you begin? The first move is setting your financial goals. Are you seeking a steady income stream or long-term growth? These goals will shape your investments and risk level. Then, select the right investment platform. There are numerous options available, from beginner-friendly platforms to more advanced ones. Let's discuss building a diversified portfolio. This means spreading your investments across different assets like stocks, bonds, or real estate to manage risk and increase potential returns. You've set your goals, chosen a platform, and diversified your portfolio. What's next? Well, investing requires regular review and adjustment. Markets should be mirrored in your investments. Regular reviews help you rebalance your portfolio, ensuring it aligns with your financial goals. Remember, investing isn't a sprint, it's a marathon. Ups and downs are inevitable. The key is patience and discipline. Don't let short-term market fluctuations distract from your long-term financial goals. Starting to invest might seem intimidating, but with patience, discipline, and the right knowledge, you can make your money work for you. So, are you ready to take that first step? Congratulations, you've taken the first step towards financial freedom. We've discussed the potential of passive income and its fundamental. We've touched upon different investments such as dividend stocks, bonds, real estate trusts, and high-yield savings. These can be your sources of steady income. We've explained the preliminary steps for investing. However, this is merely the start. Continuous learning and growth are crucial in investing. Value the journey, be patient, and keep focused on your goal, a dependable passive income. While investing can be daunting initially, remember, every expert started as a beginner. Adopting the right attitude, gaining knowledge, and using appropriate tools can enable you to excel in investing for passive income. The journey of 1,000 miles starts with a single step. So, take step today. And before you go, don't forget to like this video and subscribe to our channel for more insightful content. Happy investing!